Welcome to Ask Dad. On today's video, we're talking about buy now, pay later. The question that has come up is, why wouldn't I use buy now, pay later? It's not a credit card. It doesn't require a credit hit in a lot of cases, is what the presentation or representation is. And there's no fees, there's no interest. Why not do it? It breaks it up into more payments. And the honest reality is there may be some situations where it's worth doing. But what you have to remember is they're not doing this for free. They're not doing this out of the kindness of their hearts. They're in it to make money. So the presentation of no cost, no fees may or may not be accurate. So up front, and it's similar to a credit card. Sometimes credit cards can be a good tool to use money. The big question is, can you afford it? What I've seen in the statistics is a lot of people are using buy now, pay later, and I'm turning on the screen to show it talks about 35% of Americans have used buy now, pay later, and a lot of those are using it because something just doesn't fit their budget. Now, if something doesn't fit someone's budget, my statement would be generally, if it's not a need, you probably shouldn't do it. Because if you don't have the money, you don't want to put yourself in a situation where you're waiting and waiting and waiting. Now, there are scenarios where this may make sense. For example, if you don't get paid until Monday and it happens to be a holiday weekend with major sales and you can afford it out of your next paycheck, yeah, it'd be better to have the money saved already, but you might as well. Or if you need something and it comes up and it's an emergency and you know you'll have the funds to pay it off in a couple of months and you can make those payments, it may make sense to do it. Now, what's the difference between that and a credit card? Well, with the traditional buy now, pay later scenario, you shouldn't have any fees or interest. You just get a payment broken up over 2 to 4 months, generally, or longer, depends on the scenario. And that could make sense. The difference there's some significant differences between that and a credit card, and we'll get into those here in a minute. Before we do that, though, let's talk about how buy now, pay later companies make money. So the first, it talks about, and this is an article from ConyTechnolab.com. It mentions the primary revenue stream for buy now, pay later services are late payment fees. So it looks like the buy now, pay later companies know that even though they present this as a no fees, no interest type scenario, a good chunk of people will not make payments on time. And if they can't make a payment on time, they're going to initiate a late fee. So in this particular example, they talk about someone buys something that costs $60 using Afterpay. They don't pay it on time, they get a $10 late fee. One of the scenarios that I saw was someone didn't realize they had a 29-cent balance hanging out there after they had thought they paid it off. And because they don't get monthly statements really, they had to end up paying actually a late fee, which really increased the purchase price. And a $10 increase on $60, that's a fairly hefty late fee. So that's something you'll want to look at. Now, every buy now, pay later, or I should say most buy now, pay later, is going to have a merchant fee of some sort. And just like a credit card, when you swipe your credit card, the merchant is paying between 3 and 6%, sometimes less if they're a major merchant. And that just is kind of the cost of doing business. And with the buy now, pay later service, they're generally going to accept a percentage of their business is going to the buy now, pay later company. Another option that you'll see is what this group is calling busted loan. So if you can't pay it back in time within the 3 or 4 or 6 month period, whatever the buy now, pay later structure is, they will roll it out into a traditional type of loan, which will then have interest and it may have a fee to roll it over or things like that. So those are scenarios where people are going to have to pay additional money for this buy now, pay later service. Now, there may be some additional ones: merchant fees and commissions, interchange fees, partnerships with financial institutions. This would be something I would watch out for because that would generally be where they're going to transfer the loan to a financial institution, which would usually restructure your loan and make it more of a loan instead of a buy now, pay later service. So be aware when you're doing a buy now, pay later that it may not be everything that you're thinking it will be. It may have the appearance of no interest, no fees, but if you go outside those guidelines at all, it will cost you. Now, why would someone use a buy now, pay later instead of a credit card? Or are there scenarios where a credit card may be different? Well, with the buy now, pay later, no interest. You have a fixed period, and if that's 3 or 4 months, you wouldn't get that on a credit card. So that would be good. Late fees, you're going to get late fees on both if you're late. Restructuring costs, if you go to one of those what they call the busted loan scenario, well, now you're going to have restructure costs and you'll have interest accruing monthly and all of those things. But here's where I think a credit card may actually be beneficial, and all of this is contingent on if you can afford this yourself. I would generally say make sure you have the money in the bank before you consider either one of these. And then buy now, pay later. Sure, it may be a great idea. You get a 4-month float on someone else's money without having to lose any interest on your money in the bank. That's a viable option. With a credit card, you're only going to get 25 to 30 days of a grace period before you start accruing interest. So buy now, pay later may actually work out better in those scenarios. But here's a couple of other areas where it may not. For example, returns. With some of the buy now, pay later companies, you're going to have to get a refund from the seller, and then you'll have to send that money to the buy now, pay later company. It may be integrated, but it may not. Where with a credit card, it'll automatically, usually, go back on the credit card and pay off your balance. If there's a dispute with a credit card, within 30 days, sometimes up to 90 days, you can dispute your purchase. If someone erroneously charges money to you, or if there's a problem with the product, or if you never receive the product, if you make an online purchase, disputes become a problem with the buy now, pay later, because the money may not just go right back to them, and they may not have as good of a dispute policy. That's something you need to look into in advance, where the credit card companies are heavily regulated and they are required to have a dispute process in place. Many credit cards have reward programs where you get hotel points, airline miles, cash back, some sort of a reward for using their system. And those can actually be a significant source of benefits, where you're able to travel for free, or you're able to get cash back and use that on other things. And that may not be available on the buy now, pay later scenario. The other pieces are, with credit cards, you also get purchase protection, where if there's fraud, you can dispute it. If there's fraud on a buy now, pay later, it's really not, from what I've been able to see, regulated very well, and you may have to have more of a fight than otherwise. And with some of the rewards on credit cards, the purchase protection could be great, where if there's an accident, for example, we recently lost a bicycle that was stolen, and we were able to have the credit card reimburse us the price of that car because it had a reward that was one of the benefits of being a member of that credit card was purchase protection. So the bottom line is, each has its scenario. Credit cards have a good option. Buy now, pay later may be a good option, but both are only good for people in the right scenario, where they can afford what they're buying, and for whatever reason, they simply don't want to use their own money for it. And remember, it's only a short-term float. So if you leave your money in a bank account for a few months, you're probably getting somewhere between 1% and 3% interest. And is it really worth the headaches and the hoops you have to jump through to make the payments, versus just paying for it in cash, or buying it with a credit card and paying it off all at once? So at the end of the day, you know your budget, or you should know your budget. Make sure that you're making the wise financial decisions. You understand all of the impacts of the buy now, pay later, or the credit card if you decide to go that route, and you live within your budget. Thanks for being here. If this video has been helpful, please drop a like down below. If you like this kind of content, please feel free to subscribe. And if you know someone who may benefit from this type of video or this type of content, please forward this video to them. Thanks for being here. We'll see you on the next one.